Hey there, welcome to the Reinsurance Podcast, the place where we dive into all things reinsurance, the coolest part of insurance. We're your hosts, Jared and Ben, a couple of ex-practitioners who loved the industry so much we founded Supercede to tackle some of its biggest headaches. And we're here to share our insights and stories with expert guests as we uncover what's really going on in the industry.
Welcome back to the Reinsurance Podcast, where now usual man behind the scenes, Tom Spire, is a familiar face. Welcome to a special, not a guest, but a regular episode.
Thanks very much. Pleased to be here.
Brought your old chair back for continuity.
But you're here, Tom, because you get to hear all of the exciting stories, as our clients, especially right now, are going through their renewal preparations, negotiations, etc. And we wanted to borrow you and pull you away from that briefly to give our listeners a bit of a view from the trenches as people start to prepare. So maybe we start very high level. What's the high level mood music coming back from SIRC, Baden-Baden and Monte Carlo, all of which you've attended?
Yeah, it's been a busy few weeks. And it's a weird time of year because it's, as conference season dies down, actually like the activity that we see on the Supercede platform really starts to pick up. So you move from one kind of busy to another kind of busy, and it's a bit of a challenge sometimes. But I think conference season was really positive by the end. So it started off in Monte Carlo, and there wasn't much to say. I think following that, there was, when the main topic of conversation at a conference is about French air traffic control strikes and how everybody's going to get home, you can tell that it's a pretty benign time in the market if that's the main kind of topic of conversation. I think as we went through conference season, there was a realization that this year as a cat year has been so benign that the market softening may be maybe more softening than we originally thought. So I think people were talking about kind of low double digits. I think that's kind of the minimum amount of price reductions that people are starting to draw a consensus on, and of course that brings earnings pressure on brokers, and particularly publicly traded brokers and very large brokers, particularly brokers that have a large proportion of their business that's dependent on a percentage brokerage rather than a flat fee. They're going to need to find those additional earnings over the next 12 months from somewhere, which means the M&A rumour mill starts ticking up. There's very kind of aggressive marketing around buying more reinsurance when reinsurance is cheap, even though kind of the evidence says at the moment that reinsurance isn't that cheap. So that might not work for people. And then there's so then it goes into, well, how can we improve terms and conditions in order to keep pricing flat? How can we encourage more product development, expansion in lines? The strange thing about this reinsurance soft market is it's accompanied by an insurance soft market at the same time, and that makes it harder to drive to manage the cycle in the ways in which we normally do. So consensus is that the big brokers are going to have to find some income from somewhere, and when all other avenues are exhausted, that tends to be M&A that does that.
It's very interesting. I mean, one of the last things you said there, I guess, this parallel softening, there's probably a technical term for when they move level with each other, but I won't attempt to coin one here.
I was going to say you should attempt. You should 100% attempt to coin one.
Maybe by the end of the episode, there was something memorable enough. That trend, though, I guess. I mean, are we at a point where we might actually see so much softening collectively across insurance and reinsurance, even if it's not chasm-like, that we see a smaller insurance and reinsurance market next year? Like, is it going to be reducing faster than growth?
That's a good question. And yeah, one that there's people far more qualified than me to make predictions on. The weird thing is that people are panicking, and the main topic of conversation is, okay, how do we keep income up? How do we keep income up? Yeah. The fact is, there's still a lot of profit washing around the sector, both on the insurance side and the reinsurance side, and so it's still an attractive place for investors to come, which is actually what's feeding a lot of the excesses in capacity, which is driving the pricing down, is that it's still very attractive and profitable. And I think the moment there's an inflection point and you cease to see positive returns on equity, then I think you start to see capacity dip quite quickly. So it might be a bit of a shallower softening than perhaps we saw in the past. I don't think there's much appetite in the market to go back to the period in the mid 2010s when it was a 8-9 year long soft market, and we had a whole generation of brokers really who had never seen a hard market.
But you're also seeing, going back to the position the brokers find themselves in, I think some of the larger firms especially have sort of redoubled their efforts around building consultancy practices and strategic advisory practices and other sort of services adjacent to broking. Are you seeing that being sort of more core, like the investment in how do they deliver more insights, deliver more sort of strategic guidance on, like, that would be fee in addition to brokerage?
So I think that this kind of strong market cycle has really been driven by one metric that's kind of led people's behavior, and that's been return on equity. That's not always been the case in the past. So when return on equity is so important, what people are now starting to do is to put their efforts into anything that's going to increase the valuation of their company, or even better than increasing the valuation of your company, if you can increase the multiple by which your valuation is judged, then that's kind of double. That has a doubling impact or a disproportionate impact to that valuation, which again is going to help you kind of preserve that return on equity. So in the insurance sector, we've seen them do that by really increasing efforts to create fee income. So we see most Lloyd's syndicates now have a managing agency that they will outsource managing agency services to other syndicates under to create fee income. And what we've seen from that is, a pure risk-based insurance company is valued at around about 1.3, 1.4 times its income. A risk-taking carrier that also has fee income from services like that. We saw recent transactions with Apollo, for instance. They're looking at about 4 times income in terms of their valuation. So that fee income is making a big disproportionate difference almost to the company valuation. And I think you're going to start to see brokers taking the same tax. Same thing with MGAs, right? There's been an absolute explosion worldwide in the proliferation of MGAs, and an MGA can quite easily get to 10 times income because none of that capital is risk capital. It's all fee income essentially in an MGA, which drives much higher valuations, much more valuable companies for founders. Brokers have been aiding that boom by you see a bunch of professional services available now around setting up MGAs. Howden have launched a practice, and many Lockton have really invested in their kind of MGA capacity practice. And so they're supporting that boom. At the same time, I think the brokers themselves need to create more fixed fee income and more recurring fixed fee income as well. So things like professional services, great. Things like moving people from brokerage onto fixed fee deals, also great. What's even better than that is moving into software distribution, that kind of thing. We all know software companies are valued anywhere between 15 and 30 times their income. So that's again going to have a disproportionate effect on these company valuations.
Yeah.
Very fascinating. So I guess wading into this market, then you've given us a really good summary there of all the different macro trends, I guess, or at least insurance macro trends. Maybe we'll come back to some global trends a bit later on. How are the different personas grappling with this? So to be a buyer just now, what's it like being a buyer, and then maybe we'll come and look at the brokers and reinsurers in turn after that as well.
Yeah, generally speaking, they're quite skeptical about the kind of overtures that are coming from the brokers. They realise the position that the market is in, and they realise what the motivations of their brokers are going to be. Now, brokers are in a weird position because they need to be giving best advice. They need to be making sure they're looking out for the best interests of their clients. Yeah. But at the same time, any publicly traded company has a God-given obligation to prioritise shareholders above all else. And that's a duty that you sign up to when you become a publicly traded company. Yeah. So those are in conflict a little bit at the moment. Reinsurance buyers are conscious of that. So where they are offered an improvement in terms and conditions, where they're offered additional cover that perhaps they didn't get before in order to keep the price stable, they're actually having to go away and think about how valuable that really is. So if an additional peril is being covered, they're going back, they're scouring through all of their data, they're scouring through 5, 6, 7 years of submission packs that if they're Supercede customer are immediately available to them on a
13-second
web-based platform.
Apply filter and done.
And seeing how much impact this improvement in terms and conditions would have had in prior years. And they need evidence that it's going to have an impact, because if it hasn't, to be honest, they'd rather keep the cash.
Yep.
It's a soft market for insurance as well. And it's important that their reserves are kept topped up. We're not seeing fast improvements in the casualty space, particularly in the US. It seems like every time people stop panicking, there's another nuclear verdict in a court case that opens insurers up to additional costs that they weren't expecting to see. So they need to strengthen reserves, and can't, if you need to strengthen your reserves, you can't buy as much reinsurance. So that's.
I think that utilization of data is a shift from where we would have had in that sort of the early days of the great long soft market from sort of almost a decade ago now, when it first kicked off, where it was, we should add these terms, we should extend this coverage for these additional perils, and everyone kind of went, that would be nice, and that was sort of, it felt like they kind of went, oh yeah, we should definitely do that.
Because reinsurance was cheap,
yeah.
Right? So the return on equity was negative for most reinsurers, and that's proof that it was cheap. So you do.
But there wasn't this like interrogation of, is that additional coverage for those perils worth, or should I just keep carving? It was almost like they got everything they wanted, didn't need to attack any of it. Where now they're left in position going, yeah, but to your point, could I save a bit more? Could I keep 5% down by not having that at all, and that being a decision that they're actually at least evaluating, right? They still might choose to take that new peril, or they might choose to say, no, the data doesn't bear that out, so let's leave it off.
And there's internal pressure to keep the cash. Right? So numerous insurers that I've spoken to, their boards and their shareholders are looking with a microscope at their expense ratios, and looking at their expense ratios in isolation which can be quite dangerous, right? Because quite an easy way to improve your expense ratio is to buy less reinsurance.
Yeah.
Reinsurance is expensive.
An easy way to increase your loss ratio as well.
Right, exactly, yeah. So the loss ratio, the danger is then that because you're paying so much microscopic attention to that expense ratio, you start making decisions that have a negative impact on a loss ratio, or in fact combined ratio afterwards. And that, I don't doubt, has driven some of the deterioration in insurer results that we've seen over the last few months, is that they are a lot more cagey about the amount of reinsurance that they buy. They want to make sure there's value, but the impact of that, if you don't get that balance exactly right, is going to be that you are more exposed to these unforeseen events, attritional losses, that kind of thing. Like, like hindsight's always 2020, isn't it? Like, pandemic cover everyone thought was a waste of money in 2019, and now it's really in hindsight how cheap that was almost criminal.
And I'm sure people thought the same about the wildfires at the start of this year. So it's interesting. I wanted to maybe pause before we move on to brokers and just step into the culture and talent part of this conversation as well, because one thing I've seen, and I'm curious to see if you've seen it as well, is a bit of a shift away from maybe the way that the industry has been able to rinse and repeat historically, where we've had teams that have known each other forever and ever and ever, and they're willing to ride these very, very long cycles through, and have been more open to suggestions from a broker, for example, saying, well, we can just get you a bit more coverage for the same spend, keep the budget the same, keep things consistent, keep the relationships good. I've certainly met a few reinsurance buyers, especially earlier in their career in some senses, who have chosen to be a lot more aggressive and to say, well, no, I've looked at the numbers and that doesn't make sense. No, thank you. And I've seen some of those buyers similarly. I insist on fees rather than commissions, and start to chop and change a lot more aggressively, which is interesting. So I'm wondering what you've seen as well on the talent front. Are we going to have an indefinite just do the same as last year and we'll all ride it out together, or are they going to be a bit more tactical about reinsurance buying going forwards?
So on the talent side specifically, what we've seen is that much more experienced reinsurance buyers are now in very high demand. So I think that insurance companies are seeing the benefits of having an experienced head around for that. And sometimes that experienced head might be the chief executive or the chief risk officer, but where that's not the case, we're seeing kind of a gravitation. There's a lot of people kind of coming out of retirement to do consultancy work and things like that, because they've seen these market cycles before. They have experience of managing what this cycle looks like, and that's the way we've seen that push. But it was interesting what you said about some of the younger buyers being aggressive. What I've actually seen is actually some of the more established, mutual companies, for example, that have had a stable panel for the best part of 100 years, beginning to be more aggressive with their reinsurers. And actually, when you go and speak to them, I won't name any names, but that is coming from the experience that they had when the market hardened all of a sudden in 2021. I think a lot of them felt like they felt put out. Yeah. They thought that their relationships with reinsurers were stronger than they evidently were. Reinsurers were very, very fast to take away terms and conditions that had been in place for decades in some cases. And the relationship to them almost seemed to mean nothing. It was, sorry, our actuaries have looked at this, we can't do it anymore. The price needs to be this. And so that really hurt the loyalty that they had for their reinsurers. And I think that's what's causing some of the more aggressive moves that we're seeing now, that reinsurers are still in a very good position, but certainly less powerful in the balance of that relationship.
Yeah. Well, and the size and diversity of reinsurers gives a cedent more opportunities, where it's like even the big panels, you might have 30, 40 markets on there. And historically, like those are the only 30 that could give the capacity required for some of these big programs. It's now no longer the case. There's like that capacity is available from myriad sources, and if they want to apply pressure to those long-standing, like if it's one of those ones where if you're going to make this transactional, let's make it transactional then, and I will. The cedents have this position to lean in, knowing there's capacity around the market. They don't need to take such big lines from such few markets that they may have done.
Yeah, it just
10,
goes to
15 years
show.
ago.
We talk on this show about a lot about the relationship and how it's a people business, and how important those relationships are, and that they're forged over many years. I think it can be quite easy for a listener to listen in and think, oh, that's a personal relationship. That's something to do with how often they go out for lunch and whether they're invited to their kids' weddings and things like that. But it just goes to show that when we say relationship, we mean business relationship. Yeah. We mean mutually beneficial financial relationship over a long period of time. That's what we mean when we say relationship, and I think that's being evidenced and proved out in this time, and that the nature of that, of any kind of mutually beneficial financial relationship, needs to be based on evidence.
Yeah.
It's like an old friend that still keeps tabs on who owes who a beer, even when you haven't seen each other for 3 months. Actually, you owe me 2 beers from when we saw each other 3 years ago. Actually, it's really important that those kind of records are kept over a long period of time. Yeah. It's really important that cedents have instant visibility over the amount of money they're making or otherwise for their reinsurance partners. It's really important to see how that's tracked and trended through different market cycles over time. Yeah. So having access to all of that information about what's been bought in the past, what's going to be bought in the future, making sure that can be fed into capital models, making sure that you can make assumptions about the performance of different programs over a long period of time, and down to with each individual reinsurer, is actually the thing that underpins these relationships that we talk so much about.
Yeah. Well, I think there's been an evolution there as well, where the relationship, the human relationship and the business relationship were more closely tied generation ago, and then as the companies began to become more driven by actuaries, much more carefully managed around what they were willing to do and to let deals go through. It was subtle, but it was this transition from like that relationship shifted from that individual underwriter who had quite broad authority to like accept terms and push things through to make adjustments for a relationship, to being the company says, no, here's what it is. And it was sort of a hybrid of like the company sort of being the bigger voice there and the person still mattering. And now it's sort of shifting a bit more, ever so slightly more towards the company's decision is what's going to stand here. There's still the human piece is still there, but it is shifting more towards our company's relationship with your company's relationship.
But if you have a good personal relationship with someone, I think that still puts you in a better position for them to tell your story internally, right?
Good point.
If you can help them produce evidence that actually, over the years net, you've made $40 million out of us still, it would require us to total loss everything we buy from you 3 years in a row in order for this relationship over the last 50 years to go under the water. Like a good personal relationship means you have a champion in your corner to tell that kind of story, but you still need to tell that story.
Yeah, absolutely right.
There's no more, Jared's a bloody nice chap.
Exactly. Despite it being true.
And speaking of Jared, former reinsurance broker, we better do quick justice. I know we haven't got all that much time left, but to the brokers and the reinsurers in this market. I mean, brokers, high-level themes, of course. We've got the slow but inevitable arrival of a new broker on the scene which I think is keeping brokers on their toes more generally, reinsurer-wise. Perhaps more of a stable oligopoly with occasional new entrants, but I obviously still at the mercy of the very competitive brokers and their clients' demands. So, any interesting anecdotes we've heard from those cohorts?
Oh, anecdotes! I want to
or themes. I mean,
I think how the market will respond to Willis's re-entrance will be really interesting.
Like how you blended into the
yeah, exactly, and then dropped it from their name. But I think there's in the soft market, and soft market broking is objectively easier, despite the challenges around sort of maintaining revenues. So will that give that sort of new group of Willis brokers a greater opportunity, or make it more challenging for them to get in to those markets? But that would be very interesting to see how quickly they can sort of regain scale compared to the now sort of big 3-4 with the sort of Howden Tiger merger. Like how quickly they get back into that group will be a really interesting one to watch. They're not in the market for this 1/1 yet, are they? What's the
a handful of people.
It seems like that's been a bit unclear, and I'm not enough in the weeds of the conversations to see if they're out.
There's a handful in there. It won't be anything to speak of. I've heard they're targeting number 4 by next 1/1.
Whoa.
Which is aggressive.
That's very aggressive.
Back to that M&A strategy you were talking about.
Yeah, I don't know what they have up their sleeve, to be fair.
Yeah, that would be. I mean, but that's the really big interesting thing. I think you see this now as like an underlying theme through this story, which will be one that will make this next year really interesting for us to watch as a market.
I think so. We're looking forward to it. It starts with the 1st of January, and we'll dissect that, and then we'll go from there.
So look forward to that update.
Very exciting, and we'll have to do a to be continued at some point. And if this gets published in advance, who knows? There's going to be a very exciting webinar where we dive into final 1/1 prep, or maybe you've just seen it, or maybe you've got a chance to watch a recording of it. Who knows? But hopefully,
So
we'll
much
see
mystery. Thanks, everybody.
Thank you.
Thanks for tuning in to the Reinsurance Podcast. If you enjoyed our show, don't forget to subscribe wherever you get your podcasts and leave us a review to let us know how we're doing, preferably 5 stars. For more insights and updates, follow us on LinkedIn and visit our website at supercede.com/podcasts. You'll find the links in the show notes.